and let's now welcome Ankit Agarwal, Managing Director at stltech, joining us on the show right now. Hi Ankit, good morning and thank you so much for your time. Firstly, when I see your numbers, it looks like a solid set, especially with respect to your margins, and I believe you have also guided for a margin uptick for FY26. But Ankit, just on the profit terms, there's been a slide and once again a negative number what you have reported. So give us some guidance there. How do you see your margin shaping up in FY26, and also what's the outlook on the bottom line?
Hi, thank you. Good morning. Thank you for having me on the show. Absolutely, as you mentioned, we are looking forward to an improved performance in the coming year. If you look at the performance and the improvement that's happened quarter on quarter, you clearly see that trend in the positive trajectory, and including into quarter four itself. In quarter four, we had our best performance from an EBITDA percentage and absolute number for almost 6 quarters. So you clearly see that it's moving in that direction. And also then now with the demerger of Sterlite Networks Limited, you will also see from a balance sheet perspective, we have a healthy net debt to EBITDA ratio of 3 times. And we're also looking at how do we generate profitability, generate cash in the coming year, and bring that ratio down towards 2 times in the coming year. One of the big drivers for this will be in terms of growth, particularly in two sections. One is in the North America market, which we clearly see continuing to be very robust and growing in the coming year. And the second is our focus and doubling down on enterprise and data centers, which we also see can be very, very exciting for the company going forward.
Okay, Ankit, hi, this is Snehi also joining in. Thanks so much for joining us. Let's get some light on your order book. Your order book is looking stable at 9,183 crore rupees. Help us understand how much visibility do you have on execution timelines, and how are you planning to convert this pipeline into cash flows over, let's say, the next 12 to 18 months?
Yeah, absolutely. Just to clarify, I think the number you mentioned includes our Sterlite Networks business. That business is now demerged and will be listed separately. So currently in our core business of the optical business as well as the Sterlite digital business, which are our IT services business, we have a pretty strong order book of close to 4,000 crores. From that business, we clearly see that as our pipeline improves within this quarter and next quarter itself, we will see some more healthy order booking. We are very confident that at any point we will have visibility of between 12 to 18 months of orders going forward. And as we sign more and more long-term contracts with our telecom customers, the data center players, we'll keep updating you on how we improve that visibility.
Thank you for clarifying on that particular front on the number, Ankit. Very good morning. Dishal also joining in the conversation. And correct me if I'm wrong, about 56% of your revenue is actually coming from exports. That was the contribution in the quarter gone by. If you could help us understand what geographies are actually driving this growth, and given the fact that what you're seeing happening globally, has that impacted your business anyway?
Yeah, absolutely. We are actually being very focused on our global markets. We have a vision to make STL a global top 3 in the optical business. So that's what we're driving towards. India today is less than 5% of the world optic fiber market. So we're very clear that we need to be in the larger markets of Europe and US. This is also a market which really values very high innovation and R&D in terms of our new products that we have launched. We are very confident that we will grow our market share both in Europe and US in particular. So this is where we are focused on. And also in terms of margins as well, these are markets where we typically enjoy better margins with our new products and development. We're also looking to grow our connectivity portfolio. So currently we have an attach rate of about 22%. As we continue to improve our connectivity portfolio as well, both in Europe and US, this will ensure that we have further margin improvement. In terms of the tariffs and other elements that are happening in parallel, we are actually very well set up in terms of our global operations. We have a strong mother base, so to speak, in India, but we also have very strong operations across in Europe as well as a state-of-the-art facility in US. So this helps ensure that wherever the demand is, we're able to cater to the customers locally.
Just wanted to check on the debt levels as well while we are talking of to reduce this number going ahead. If you can give us some sense that at the close of FY25, where are we, and for FY26, what kind of a reduction are we looking forward to? And also just a follow-up on the margins as well, since you are positive on building on to this number, any indicative range that you can help us with, that where are the margins headed for FY26?
Yeah, absolutely. I'll start with that part. I think basically today we are at close to between 45-50% of factory utilization. And as our market grows both in Europe and US in the coming quarters, the aim is to take that to at least 70% utilization plus. And we've seen that historically, if you see our FY23 numbers, etc. Once we start doing that, we quickly move towards between 18 to 20% EBITDA margins. So that's directionally where we want to go through the course of the current year. And if as our volumes in the right markets grow, I think we're confident of making that happen. Ultimately, with this kind of profitability and generating cash, the thought is to utilize that cash and further reduce our debt. And the thought is that basically we're at about 3 times net debt EBITDA, and we bring that down to 2 times net debt EBITDA, and that's what we're gearing towards.
Right. Ankit, you did speak about the fact that how you are actually progressing in order to make STL as among the top 3 global players when you talk about optic fiber. I just wanted to understand, I don't think we spoke about what's your guidance when you talk about the revenue figure. You did speak about margins right now. What's your take about that? And also your domestic and export mix. How is that likely to change going ahead? Are you going to maintain at these levels where you will have the predominance of export on your revenue?
Yeah, I mean, you touched on the domestic market. I just want to take a small caveat and say we're very proud to share that our team, Sterlite team, had a small but important role to play in Project Sindoor as well, where our team was at the front lines in Jammu Kashmir and other locations, providing continuity of networks for the Indian Armed Forces and Air Force, etc. So just wanted to call that out. Very, very proud of our team. And if they're watching, I really want to give a shout out to them. In terms of domestic market, it's actually going to be quite interesting for us because the Bharat Net Phase 3 will kick in over the next few months and will last for at least 3 years plus in terms of network build out, as well as another 10 years for maintenance. So STL will provide optic fiber cables and connectivity across the various packages. And that's something that will help the demand in the local market. And of course, from an impact perspective, that will create high quality fiber networks to every village in the country. So that's where we're really focused. Of course, we work with all the telecom operators and ISPs in the country, but the big jump, I think, will come from the BharatNet project going forward.
Before we ask you the next one, just want to wish you and the company congratulations for playing a key role in Project Sindoor. Of course, quite prestigious for our country, that project. But let's move on and talk about your other segment. You spoke about the optical fiber. I want to understand where we are headed in terms of software and digital solutions, because that, as I understand, is still it's a small portion of your overall pie. What is your strategy to scale this segment, and how do you plan to differentiate this segment given the kind of competitiveness that we're seeing in the overall market?
Yeah, absolutely. I think for us, it's a small but exciting business. We have a great leadership team with great experience over 25, 30 years. And as we've stated in the past in our investor calls, we're keen on just scaling this up by step. But what we're really key is that it should be profitable and generate cash. So happy to share that now for a couple of quarters, we've had EBITDA neutral or profitability. And clearly now with further growth in this business, we do see that with the same cost structure, we should get to cash profitability in the next couple of quarters. So that's really where we're focused. We have absolute tier 1 clients in this business, the likes of Orignon, the likes of IBM, Oracle, very, very high quality clients. And certainly with their growth, we can improve. You asked in terms of our differentiator. I think it's really in terms of agility, in terms of moving quickly and really executing what we promise. And I think the customers really appreciate this, and we're able to compete with the tier 1 players globally just on this basis.
Lastly, Ankit, you did talk about the Bharat Net Order win that has been significant for you. Almost a 2,600 crores order win is what I see, and that will be a part of your digital business service. Give us some sense that are you optimistic of more such orders in this particular fiscal?
Yeah, so just to clarify, this is the order we have won for about 3 years of deployment and 10 years of maintenance. This will be part of the Sterlite Networks business, which is now demerged. And there the business will execute this particular order. We're very proud of supporting Jammu Kashmir going forward. In terms of Sterlite Technologies business, this business which we're speaking about, this will provide the optic fiber cables and connectivity not only to Jammu Kashmir but to various other parts of the country as the various projects get rolled out. In terms of the Sterlite Networks business, that is something that we're clearly seeing that we want a good mix of fiber network rollout, but also system integration, which are typically higher margin business and better cash cycle. So that's really where the focus is, to improve the margins of that business, take it towards 8 to 10% EBITDA, and then make sure that we have a better cash cycle in that business.
And lastly, Ankit, I just wanted to ask you about your capex. Are you all looking to go ahead and deploy fresh capital in the new FY? And also wanted to understand any strategic investment, M&A that you're looking at. You did speak about the divestment of the Sterlite Network business. But apart from that, what sort of plans that you have for the company going ahead?
Just to clarify, it's a demerger of the Sterlite Networks. It's not a divestment, so it will be
I stand corrected, demerger, yes.
Will be separately listed in a month and a half or so. In terms of investments, we've actually done very large investments over the last 4 or 5 years in terms of building our capacity, really to make sure that we are world class, including our latest facility in North America. What I think we will do is definitely make some important investments in R&D. We have more than 750 patents now. So that's clearly a big focus for us, is that if we have to win globally, it will be through technology and differentiation. So definitely there will be some good investments in this year and the coming years on R&D. That's really where majority of our capex will go.
It sounds good. On that note, we'll let you go. Thanks once again for joining us and sharing your company's quarter gone by and the outlook going ahead. Thanks.